Barrett says 2015 farm income numbers from producers working with Nebraska Farm Business Inc. have been finalized, and for the first time since 2002, that group experienced a loss in net worth. It was also the largest nominal drop in net worth since 1984. The collection of farmers and ranchers also saw a sharp drop in net farm incomes. For perspective, the USDA totaled 2015 net farm income at $56.4 billion, a drop of 38% from 2014 and 54% lower than 2013. Tina joined us earlier this week to discuss working capital, debt-to-asset ratios, and net farm incomes in 2015.
As we expected, net farm incomes are down considerably. We were thinking maybe 50,000, but ended up coming in just under 30,000 on average, right at 29,000. So certainly a significant drop, about 80% off of 2013, 2014 returns.
Would that be the lowest since a certain year?
Lowest since 2002.
Okay.
So, kind of puts us back into that perspective, in a time when we had $2 corn and $4.60 for beans. So, same income, but very different situations.
Was there a difference between crop producers and livestock producers?
Sure, and in the last year we saw that where crop producers lost and livestock producers gained, and we came out the same. Well, livestock producers kind of joined the crop guys a little bit this year and probably went farther down. So crop guys saw about a 45% loss, while the livestock guys just went from the top of the heap to the bottom.
Yeah.
So
how are expenses eating up margins?
So, expenses are obviously just big. We did see in our irrigated corn per acre, total expenses on average dropped about $40 an acre. So we're seeing that come down a little bit. But we're also seeing a very big spread amongst producers. So if we look at our high profit third for irrigated corn per acre versus our low profit third, we have about $300 per acre difference in what those two averages are showing us. So it's certainly not everybody's handling it the same way.
Where's that coming from, that $300? Is there a clear flag somewhere?
Well, the biggest difference is cash rent. So if we're looking at cash rented acres that we're getting, either having some long-term rents, some bushel leases that are automatically flexing, some flex leases that are out there, or ability to negotiate down. So 150 of it's coming there. The other half is coming from other operating expenses.
How are you noticing that this is impacting debt on operations?
Yeah, so we've been watching debt climb over the last 10 years, and it's kind of been a struggle to know that we're going through our 10 most profitable years, and debt continues to go up. We've seen that level off a little bit. We've been sitting just above $1 million for 3 years. A little bit of an increase, but really kind of the same this year.
What about debt-to-asset ratios?
So debt-to-asset ratio, if we're looking at the whole balance sheet, still looks pretty good. Debt-to-asset ratio is 28%. That is 1% higher than last year, which was 1% higher than 13. So we're seeing a small climb there, but still a very healthy position.
And working capital?
That's the problem when we're seeing what the balance sheet is. So from our current position, the stuff that we have to sell and our payments that we have to make this year, we have an imbalance. We're seeing that number drop. Our working capital to gross revenue, so if we're comparing different size operations, that number fell below 30% for the first time since 2006.
So this is a little bit concerning to you, yes?
It is certainly concerning in the short term, and it's a matter of we need to understand why that working capital is going away, or why it's not where it was before. There's lots of good reasons. If you went in the last couple of years and bought a lot of ground with cash, maybe we need to put that on a long-term loan and get some working capital built back in the operation. If your working capital is deteriorating because your family living's out of control, we got to get that fixed before refinancing is going to do us any good.
You mentioned family living. We've talked about it for a lot of months now.
Yeah.
What happened last year?
So we saw a little bit of a decrease, which is really good. So we're about 92,000 on average for family living, which still seems high, but it's less than the 100,000 that it was in 2012. So we're seeing that start to come down. The problem is with 30,000 net farm income and 17,000 of average wages, we just don't have enough income to cover that. And so it's going to have to be cut more, or we're going to have to go out and find some other non-farm sources to get us through this period.
What's the take-home message here as we at least get ready for the 2016 crop growing season?
I think as we see these separation of the farmers who can cut those costs and those who haven't, I think one of the things that's really important is to look at your costs and to know your costs and to do something about it. And that means we're doing some cash flow planning, not something that you get to the bank so that you can get a loan, but a cash flow that you're really working with on a regular basis, that you're updating, that when you're making purchase decisions, you're thinking about it and working on that. So, it's really going to take some planning as we work with these tight margins. It can be done, and that's the important thing.
Our previous episode of Market Journal featured an interview with Kansas State University's Greg Eibendahl regarding U.S. ag loans and debt-to-asset ratios. You can find it on our website or YouTube channel, as well as through the Market Journal mobile app.